Thank you, Gary and Dan, for joining us today. And I'll pass it over to you, Gary, to introduce yourself just a bit more and tell everyone about what your group does.
Sure. So I'm Gary Reeder. I'm the CEO of the American Fintech Council, which is the largest trade association for the fintech industry. Prior to being at AFC, I've had many gigs, and I know a number of you from various versions of that. I spent about 10 years as an asset manager in financial services, and then I was at the CFPB helping set it up after doing a stint on TARP at Treasury. Then I've been a consultant and an investor and have helped develop different startups in the financial services industry. And prior to this, I ran the Financial Solutions Lab, which was a collaboration between JP Morgan Chase, Prudential, and the Financial Health Network, where we had a $65 million portfolio focused on mission-oriented fintechs. And I spend most of my days trying to help our members navigate Washington and the states, because as many of you know, the states play just as they play almost a predominant role on the legislative and regulatory side, since most fintechs are not banks, although that is changing.
And I'm Dan Smith. I'm Executive Vice President, Head of Regulatory Affairs at the Consumer Bankers Association. We represent the largest institution in everything retail banking. Prior to joining CBA, I was at the American Bankers Association running the credit card policy. Spent 6 years at the Consumer Financial Protection Bureau, started in April 13. Gary interviewed me and then left. Like the day I started, he walked out the building. I should have known something right then. Before that, I was at Freddie Mac during the financial crisis, 2019 to 2013. Don't ask me what I was thinking. Going to a GSE as it goes into conservatorship, and then going to the CFPB. So do not follow me in your career at all. Not a good choice. I've spent my career dealing in policy issues, consumer, direct-to-consumer, all the way through in the mortgage market, now everything in consumer finance. That's where I live. My space is what's going on. I've worked at the Bureau on every single policy issue, from 1033 to the small dollar payday rule. You name it, I was involved in it. So.
Great. Well, thank you guys. I'm so excited that you're here, and I've been very excited for this panel since our prep call, which was very lively and fun. So I'm expecting nothing less from you today. So I'll just kick started with a couple of questions, and then feel free to take this conversation where you think is most beneficial for the audience. But at Plaid, we consider ourselves an open finance company. As you all know, we work with thousands of fintechs, many of the Fortune 500, many of the largest banks, to make it easy for people to connect their financial accounts with any apps that they choose. So we feel very strongly in the principle of open finance. Our company is founded upon the fact that consumers own their data and have the right to access it from wherever they please or take it wherever they want it to go. So everyone has a different perspective and definition of open finance, and so I'd be interested in hearing how your organizations define open finance and where you feel we are on that journey to full transparency.
I think, Dan, from the bank perspective, it'd be interesting to hear that first.
I mean, it's evolving. It's evolved a lot from 2013, 2014, as the Bureau started its conversation around Section 1033, which is a Dodd-Frank required rulemaking on open banking or consumer access to financial records. It's the linchpin, thank you, to what will be the future rulemaking. So banks have evolved in their thinking. At first, they're like, oh my gosh, what is this? This is our information, and it's changed a lot, and it continues to evolve. Fully supportive of the rule, working to find a balance, to make sure that the consumer is always placed first. I think that's how banks look at it, is they're our customers. We want to service them. We want to provide them the best service that we can, and open banking can help that.
Yeah. So, it's been evolving on the fintech side as well. I think there was, if I go back to even 2009 when Dodd-Frank was written, when 1033 was written, all the things that most of you do today weren't really contemplated. It was more like, okay, consumers have transaction information, and generally it should be portable. They have the right to move it. I think I was there. I think that was kind of the thought. And I've said this openly to regulators, so I'm not saying anything I wouldn't say to them. by letting 12 years go by, I think that rule may be inadequate in order to deal with the world that we are actually in now, and then consider the world we may be moving toward. But it is the only vehicle available from a regulatory standpoint that doesn't require the Congress to make a statute, which if any of you pay attention to Washington, that's not really what we're good at anymore. So it comes down to the regulators. And I think Plaid in particular has done a great job trying to get action there, because I think some of us believe that the rule is self-effectuating and is already really the rules that everyone should be following. But either way, it's pretty clear that the Bureau is not doing that this year, that it is more likely next year. And the way we think of it most broadly is that consumers have rights about how their data gets used, for what purposes, for how long, by whom. Ownership of data is a more complicated challenge just because it's an intangible asset, and the more that people use it, the more valuable it is. And once you go down a pure ownership path, it kind of could break the value. But I will say, and I think maybe the banks would share this view, as markets often do, and this is really business-to-business relationships, people have come to contractual, agreements that in some ways have far outstripped the government reacting, even though the government had the authority. So we'll see what 1033 does, but in many ways, it appears from my members and from working with banks that a lot of that has been sorted out among businesses. There may be places where the government wants to reinforce certain protections, perhaps, but it's not like it was, I don't know, let's go back 8, 9 years, or for you guys probably 7 or 6, where some of the large banks basically told you guys and others, go
We won't say
F
that.
yourself. We're turning off the spigot.
I don't think I would have used that term, but okay. But you are right, though, right?
That was the
changed.
attitude.
The market's changed dramatically.
Yeah.
The way that we look at things have changed. Back in 2014, the CFP put out an RFI to gather information. In 2017, I was part of the group that wrote the principles, right? It was done very carefully, thoughtfully, with one thing: don't screw it up. Right? This market is evolving rapidly, and the worst thing the Bureau could do at the time is put their thumb on that scale too hard in one way or the other.
Right.
And that continues to be the case today, and I think when they do come out with a proposal, you will see that it's going to be very cautious, very carefully thought through some very complex issues.
Are there places of friction that you anticipate between banks and fintechs at that time?
There's always going to be some. I think they're a lot less than they were 6 or 7 years ago.
Yep.
With the development of APIs and the partnerships with banks going on and the contracts and everything that's working in the right direction,
Right.
It actually may behoove the Bureau to actually take a step back and let the market keep evolving.
Right.
Because if they come out with a too restrictive rule, they're going to put that thumb too far on one side or the other, which in the end could hurt more consumers. So they have to be very careful, and we'll get deeper into what we think is actually going to be in the rule. But there's a couple there that are very difficult to deal with, and that's why it's taking so long. These are not simple things to just take out your pen and start drafting a rule that will be hundreds and hundreds of pages.
Can't wait to read it.
Yeah, I think the other thing is there have been not just trade associations but coalitions that have been working for now almost a decade on things like security, identity, because those are real-world friction points for everybody. No one who uses the data wants to be in a position where it's not secure, and obviously for banks, that is a serious issue that they have to deal with their supervisory authority, the supervisory authorities that are talking about these things. And we've moved from a world over the last decade where you might have two guys sitting in a basement drinking, Mountain Dew, screwing around with someone's computers to, a state actors. This is those kinds of questions have gotten a lot more serious, and the amount of data that's available about people has exploded. So I think those are the things that still are being worked out. But once again, industry groups have been doing that for a long time, and I think that, to your point, should take some of the main friction that we would in 2013. This could have been an all-out war. Where
Right.
now it's more like we're kind of 90% of the way there, 80% of the way there. We just need you to close this box off and we can move on.
Okay, that's super helpful and interesting. Let's talk about something I think that is key for both banks and fintechs, and that's consumer trust. So, you talked about all the data that's available. Consumers are increasingly, managing their finances in a digital world. And so how do we anticipate this will be treated by regulators, both for fintechs and banks? And how has open finance benefited consumers already?
Yeah, I mean, well, one, we just lived in a very sort of binary world before where you either could meet these 6, I mean, this was sort of what we talked about earlier today. Here's these 6 pieces of paper, and here's what you can access if you have those pieces of paper, and here's the institutions, and you have to drive your car or walk to a box made out of bricks to go inside and talk to a person who uses a computer who then connects to 3 core operators. And that was kind of how it worked. And all of that was stovepiped, right? So if you wanted to do work on your bank work, you had that. If you had a payments product, you might work with someone else. If you worked with someone for your investments, insurance, so on and so forth. So now we're in a world where the easy flow, which has some challenge, but that easy flow of information among multiple providers that can then be aggregated together and either be used by the consumer through certain applications so they can manage all of that, that's been tremendous. I think that payments in the United States is an embarrassment. I mean, it is, if you've traveled anywhere in the world and you come back to the United States, it's pretty embarrassing how bad that system has been. And in the last 10 years, we've made huge progress, but I would say still in payments and the ability of people to manage their own financial lives themselves across all these different providers, that's been tremendous.
Yep.
I mean, I think that has, once you have a mobile phone, you take away a lot of the impediments people had to just access the services. So I think that has been tremendous. I think the challenges are we're always going to have people at the edges of society where whatever form of access we have, they will not be able to do that for any number of reasons. I think we're closing the gap there, but that's not going to disappear. And then we've now moved into a world where financial services and the way that we provide them and the way that we monetize them is as much about the data as it is about the financial asset that is being held at an institution, particularly for low to moderate income consumers, higher net worth individuals. There's a whole slew of fees and other things there. But for a lot of people, their data now is becoming the thing that is what fuels the process rather than the asset. And that, I think, poses some regulatory complexities.
Well, Gary's sort of evaded, but I'm going to poke the bear.
Sure has, hasn't it?
I'm going to poke the bear a little bit.
It was a
with you,
good
Dan.
evasion, right?
It was a great answer. But Dan, tell me how you're feeling about fintechs and regulation. Just for fun, just for starters.
There's the softball.
You worked at the Fed. You know how this works.
So, I mean, the one thing we all have in common is we want to serve our customer and the consumer. And we have to go about it different ways based on the asset size, the institution, who our regulators are. And as we develop, those rules and oversight need to change as well. So, the banks believe that fintechs have grown up, right? They're no longer the mom and pops in their garage, right? They have enormous size growth in the last 10 years. And in order for both sides to compete fair, there should be a level playing field. There should be oversight. And the reason isn't just so that we can compete equally, because we'll never compete actually equally, but it's to protect the consumer, right? It has to be about protecting the consumer. And we think it's important that we look at the regulatory structure. We look at the way that the rule that's going to be coming out, he says next year. I think that rule's been in the process for years, and it continues to grow. How that creates a competitive balance. Competition is really what moves markets, right? Regulatory pressure can influence it, but it's really about competition. And so creating an environment that all players can compete on a level way will help the consumer in the end.
Well, and I'll answer your question
I knew you
directly.
would.
You know, the most direct difference between banks and non-depository financial technology companies is primarily around supervision, right? So enforcement laws apply to everybody. Some of you in this room probably have had a little bit of experience with that. It's not much fun, but that is definitely true. That does apply. But supervision is a place where, you know, I think Plaid, you know, at least conversations I've had with the Plaid team, I think you and many of my members are in the same position, which is supervision for entities in a shared marketplace being supervised by federal authorities is not a problem.
Right.
That is actually a much better outcome. It creates more stability. It creates even competition both with depositories, non-depositories, and within each submarket, so that we don't have a world where, and this can get into some of the announcements from the Bureau recently, where you could have one player in a market be supervised and the other 10 players not supervised. That doesn't protect consumers. That creates a bit of arbitrage between those who are supervised and not. So we in general think that supervision of larger participants, which is a technical term, but of larger participants in the fintech industry is a place that we should be moving toward. And Dodd-Frank creates a very transparent, clear process by which to do that. And I think that that will be the best, most direct way to create competition and protect consumers. And for many of my members, the challenge is in the absence of federal supervision, and state enforcement actions are much more complex to manage than having, even if you may not agree with your particular regulator at that time, having one main supervisory authority that has to coordinate with the others is a vast improvement. And I think that's a place where banks and fintechs in general agree.
Yeah, and you know, if the Bureau is going to write a rule that regulates the entire ecosystem, they really have to have a purview into the entire group so they can make sure that everybody's complying with the same rules. If they don't have a full picture, then they don't know if the rule's being effective or not.
Yes, great point. Okay, so we're going to move on a little bit from open finance and talk a bit about what we see going forward. So outside of 1033 and open finance, are there other regulatory areas that you have your eyes on for the next year or two of interest?
Sure. You know, the Bureau is the driving agency on most consumer protections, but you know, there is a joint rulemaking on Community Reinvestment Act. There is what's referred to as 1071, which is small business data collection. There's a lot of stuff going on in the regulatory space that will impact all customers. You know, the Bureau talked about using, I think you alluded to, their ability to supervise a non-bank individual. I think we're going to see some larger participant rules out of the Bureau because of the gap that the rulemaking on 1071, the small business data, they don't have the authority to go and examine 30% of the market. So 30% of small business lending is done by non-banks. Bureau can't go in and examine to see if they're complying. I think 1033 is another example where they're going to have to write some kind of larger participant rule.
Yeah, so I think CRA is a big one, particularly if you, many fintechs, at least 10 of my 65 members are now banks. So once you become a bank as a depository, you have Community Reinvestment Act obligations, which come down to, you know, the amount of loans, small business, and mortgages that you make in your assessment area. There are people who spend their entire careers just defining what the heck an assessment area is. But obviously in digital operations, you may have a bank in Salt Lake City, but the vast majority of your customers are in 10 other states.
Right.
That wasn't contemplated when the law was written. And so that is something we need to work through. I think that one piece that is still people are trying to sort out is the CFPB has not only reiterated its commitment to fair lending enforcement, it has said that it's going to go beyond Reg B, which is the regulation, Equal Credit Opportunity Act, that gives them the power over fair lending and began to use what's called UDAP authority, which is unfair, deceptive, and abusive acts and practices, which means if it's bad, it's bad. It might not have a specific statute that says that thing is bad, but if I can prove that, you know, it was deceptive or abusive or unfair, and there are prongs in the law that say what that is, then that can also be joined with what had been mostly statistical analysis.
Right.
And that creates a whole set of challenges, particularly where AI and machine learning and the desire for many firms to begin to move away from just FICO-based credit scoring. Once you start introducing non-statistical measures, it gets even more complicated to be doing things like using non-FICO-based underwriting.
So I'm going to dive a little bit into 1033 because I want everybody to really,
Yeah,
hear what
important.
we think is actually going to happen because I think we brushed over that a little
Okay.
bit.
Get
So
right in there.
the Bureau is required to write a rule. Statute requires it, no date or time. It's been over 10 years. They haven't done it yet. They've put in their unified agenda, we're going to write a rule. So they're in the process of gathering the information, developing their thinking. The first step will be what's known as a SBRIFA panel, which is a small business review. Any institution that is defined as a small business, the Bureau must have this panel where they sit down and talk to them about an outline. Usually that is done 5 or 6 months before an actual rule comes out. They will put out publicly an outline of what they are thinking of doing in a proposed rule. It'll be very large. It'll be very comprehensive. It'll ask a bunch of questions. And then they'll have that session, they'll write a report on it, and then they'll drop a rule, right? The proposed rule. And then there'll be a comment period. Comment period's traditionally 60, 90 days. So let's just hypothetically say SBRIFA comes out in the summer. Fall, they actually have the panel. Proposed rule comes out early 23. There's a comment period of 90 days. Then there's another 6-month period before the actual rule comes out, the final rule. So you're talking at the earliest, in my guess, 24 before you actually see a final rule out. So that really helps you think about the time. It's not quick. The big key components are going to be data security. And we agree on a lot of these things that they were in the original principles and they hold true today. Data security, access, making sure the consumer knows, right? Informed consent. Liability, probably the biggest issue. Like when that information leaves the bank and goes into the data aggregator and then to the third party, who's liable if there's a breach? That is probably the biggest challenge for the Bureau. Supervision, which we talked about, I think that's really important. That's a tough one because of the statute and the way that the ability to regulate and supervise entities is defined, so they have to be creative. But as we've seen with the Bureau, they can be very creative, and I think they'll address that.
And there's another period after they drop the rule, which is an implementation period, which is usually somewhere between 12 and 24 months. And I'm not here to hawk the wares of a trade association, but I will say this, what he's describing is part of the reason the trade associations exist is because everybody has a business to run. And this is just one rule, and there's multiple agencies doing all these things, and part of it is to have people who this is what they do, and then also speaking on behalf of a whole industry or a whole marketplace, because the other thing is having your specific comment from your specific company, you have a legal right, and you should take advantage of that to respond as a company. But in all fairness, when it's the industry's voice speaking, then it's taken differently, and there's more back and forth. And so you'll be seeing more of that under this administration. Just the last administration was not in a rulemaking kind of mood. So we'll just say that is going to accelerate, and part of what the team at Plaid does, what the team at various trades do, is try to manage all that so other people can go about their business.
Right. And with the, with how financial services has been evolving and the pace, how do we expect policymakers to be able to keep pace with
Good luck.
They won't.
They never do.
They
right?
won't.
They can't. They're always reactive. Like, I can't think of a rule that, like, an agency's come out. Look at crypto right now.
Right.
They're way behind, and they're trying to figure out just how to even get started in that conversation.
Right.
And to be fair to them, there's also forces at play, both economic and political, that try to slow down, speed up various parts of that. So there's an ecosystem where there are interests that don't want certain reactions or want reactions in a very narrow way. You know, yeah, the blunt reality is if you look at the history of financial regulation in the United States, it's all crisis driven. So the SEC comes about in 1932 for a reason. There was not a sense of like, oh, we should do this until the entire market melted down for a much longer period. There have been meltdowns in the past, but nothing of that magnitude. CFPB, without a mortgage crisis, wouldn't have happened.
Right.
Without a number of commodities failures and futures trading, CFTC wouldn't exist. So these things come out of
And I think
crisis.
there's a good reason why they're reactive, right? As you think about it, the 1033 rule is really the only one that hasn't come out of a crisis, and it's developed over all these years. Just imagine if the Bureau decided in 2014 to write a rule that regulated, you know, the consumer's access to data would be much different than it is going to be now. Right? So they actually were very smart and sort of stopped and thought and said, we don't want to influence the market too much.
Yep.
Right? The whole thing was consumer, consumer, consumer. When you, the fintech, or you, the bank, are having to deal with this issue, make sure the consumer is front and center. And the market's developed. And now they're in a much better place to address the one or two or three things that are going to be difficult for the parties to align.
Yeah.
And it's really, you said 80%, it's probably about right. We're pretty much aligned on about 80% of what a rule should look like. The devil's in the details, of course, but.
Well, you brought up two things. One's crypto, which we're going to get to because I feel like I have to ask that after the past couple of weeks. But first, let's talk about like the change in the dynamic between fintechs and banks. We touched a little bit on this, you know, earlier, but when fintechs first came out, they were seen as a major threat to banks, and now today the relationship is much different, complex, we'll say. But you know, banks are acquiring, partnering with fintechs, taking leads from them in terms of product offerings. So, what do you think the future of this relationship holds?
You know, let's roll forward 20 years, which none of us have any idea what that will look like, but that way if it's far out enough future, I can't possibly be wrong. But if you think about just the way general markets grow up, if you look at the pharmaceutical industry, over time you have this consolidation where you have these very large regulated entities that do everything from the creation of drugs to the distribution, marketing, and all of that. And in many ways, the largest banks in the country are these sort of completely integrated large institutions. But once you get to that size, and once you understand how supervision works, it is extraordinarily difficult to do a lot of new things where you're just starting from scratch. That is not the way you run an institution like that. So if you look at the last 30 years, say in pharmaceuticals, biotech and other things came along that they take all that risk. A lot of that risk is borne by venture investment rather than, in the case of banks, by depositors or bondholders. And over time, those things get acquired. My view is that that's kind of where we're headed. You know, there are different people who, you know, might disagree about who's going to do the acquiring of whom and what that means, because from a regulatory standpoint, like that's a bank buying something and someone buying a bank is really different. But I see that world, and I think the bigger concern, and I've shared this at other events, is financial institutions, whether they are a one-person fintech or they are JP Morgan Chase, the more fundamental question we have to ask ourselves and be concerned about is what's the role of very, very large technology providers in playing in the financial services space. So, you know, people will say to me, oh, I'm worried about fintech. I'm like, what you should be thinking hard about is Google, Amazon, and Facebook, if they want to be in financial services, that is a much larger policy question than whether a bunch of people want to create a firm that they're either going to sell to someone else or buy something. So for me, I think that fintechs and banks generally have much more aligned interests and share business. You know, the businesses we're in are almost identical, where these bigger questions around the competition that large integrated technology providers, what their role in financial services is far more foundational to how we run the system. And then lastly, particularly for smaller banks and credit unions, they just don't have the capital to go out and attract the talent that they need, to make the investments that they need. And for each of them to go build something separately is insane. That's just not how you should run any good marketplace. And so I think there you already see a lot of good work together, where I do think many of us would want to still have branches all across this country, particularly in rural parts of the country where that's how people transact. But those firms, those banks cannot be around 20 years from now if the economies of scale and the efficiencies that technology bring are not available to them.
Which is why we're so excited to launch Core Exchange
Yes,
today.
exactly,
Yeah.
exactly.
You nailed it on the head. It's consolidation. You look at the automobile manufacturers. You know, when automobiles started, there were hundreds and hundreds of manufacturers. It basically went down to 3, right? That's what you're going to continue to see. And that's okay, right? As markets develop and grow, that's what happens. I think you hit it perfectly when you talked about the big tech. I look at fintech in 4 different ways. You look at the personal unsecured installment loan. You have the data aggregators. You have the deposit, the Chimes of the world, and the payment space. The payment space is where you really got to be paying attention, because they are the big dogs, right? You look at some of them are enormous. Their number of customers they have access to, and they're not just payments companies anymore, right? They're lending, right? They have credit. They're doing a lot of things beyond just payments. And then you have some of those Amazons, Walmarts, Apple, that are just sitting there waiting, trying to figure out, how do I get into this space, right? They all now have financial products using third parties, but eventually they're going to say, why am I having a third party? I'm going to do it. And then we're going to get into a legal fight over the Bank Holding Act, which I really won't go into, but it basically says a bank can't also do commerce, right? So the opposite should apply. Commerce also can't do banking. Eventually that will be triggered, and someone's going to say, no, Walmart, you can't be a bank and a commerce. Yeah. So that's a couple years down the road, hopefully, but I think you're right. That's exactly where we're going, and that's what I think both fintechs and banks sit there and worry about, is those big guys. And the good news is you have a director at the CFPB that is really concerned about big tech and data and privacy.
That's true. Okay, so I'm going to ask the crypto question. Just, at Plaid, we want to support consumers in the many ways they choose to manage their money, just to lead, healthier financial lives. But are there lessons in fintech's journey becoming a more mature industry that you think we should apply to Web3 and crypto, given what's happened in the last couple of weeks?
Regulation can be good for you. There is no regulation, and you can see the risks that are associated with that, right? I think for the banking space, it's all about payments. It's all about blockchain and technology, and how do we move money quicker, faster, safer. And you can see blockchain being that approach. Stable coin, those are the kind of things that we think about, and how do we try to bring bankers in that space closer to understand. I think that'll be where we see the fastest growth in banking, is around payments.
Okay.
I don't represent any crypto firms. I have never invested in crypto. I would not let any of my friends invest in crypto.
Tell us how you really feel.
So
I
I'm just
agree.
going to be,
I haven't either.
so that's my biases, right? Because it's better just to put that out. I used to be a short seller in a prior life, so all of this does not look sustainable to me. That's personal. Professionally, I agree that there are use cases around payments and the custody of assets and how we move them. We have a very antiquated system for settlement, just the settlement of securities. I mean, if any of you ever worked in asset management or had to take the various Series 7s and all those, you learn T+3, 3 days of settlement. Really? That's true when literally there were giant wheelbarrows full of stock certificates that moved around the floor of the exchange, but that's still how that system can behave. So I think those are good. Having issued thousands of coins, which you basically think of as different currencies in many cases, is a return to the 19th century. It is not the 21st century. We're returning to a world where any institution writes script, then that script, you can take it and trade it for some other script, and there's no requirement to have anything behind that other than the sort of nebulous trust, not actual liquidity, not actual assets in most cases. And we, at the Civil War, we created the National Bank Act, and we said, no, there's going to be one currency of the United States. And then we created the Federal Reserve Act and said that's going to be controlled by a public-private partnership between banks and the central bank. And that has done a very good job at creating far more stability and less problems with, consumers, back then primarily farmers and merchants, suddenly waking up and all their assets are worth zero. And instead of it being a form of payment, the payment system and asset values were all scrambled together. We separated those for a reason. And so my view is that, like much of American politics, is returning to pre-Civil War, 19th century mentality when we spent a century going through a lot of pain and suffering and decided that we wanted to centralize certain activities. And some of the libertarian bent that people have, I understand that. I get where people are coming from. At the same time, if you want to run a society of 330 million people in a world of 7 billion people, anybody being able to create a store of value that they control is probably not the way to run a system this big. So I think I've made myself clear.
You think? So we just have a couple of minutes left. I want to ask just one final sort of rapid fire question. We're all former regulators here. So what is one thing you want the audience to take away, and pay attention to in the coming year? So we're speaking to everyone from large and small banks, mature fintechs, startups. So what should be top of mind? I gave you this question in advance.
I know.
I know.
It doesn't. That makes it harder in some ways because you can just make something up if you haven't thought about it. I would say that we are just now getting to a place where the majority of financial regulators have people in charge that are going to be there for some period of time. The start of this new administration has been slow in getting people in these jobs. The people in these jobs matter tremendously for what happens over the next several years. And we still have issues at the Fed. We still don't have a confirmed comptroller. We may be getting a head of supervision for the Federal Reserve System as vice chair. But all of those things are part of a bigger trend where the regular order of financial services regulation has fallen apart, just like up on the Hill. And that has created this world where the cycles are getting shorter, which is harder for us to do our jobs, but also that the Congress is likely to change. The regulators themselves are just getting into position. They're going to be pushing pretty aggressively over the next 2 to 3 years to maximize their impact. And so you're just going to see a lot more activity where I think some people have been lulled in the sense, the last year and a half hasn't been that busy. Maybe things are not going to change that much. There are people from the FTC all the way to the CFPB who are heavily incentivized to begin to take very aggressive action. So that's not a specific thing, but the volume of things that you're about to see and the aggressiveness of some of that, I would say, could catch a lot of people by surprise.
Not you and I, though.
That's what I stay up at
I've
night
been
about.
screaming and yelling like be ready, because it's coming.
Okay.
It's not like if, it's when. I'm going to take a little different approach. 30 seconds.
Yep.
What you're going to see is change in the market. Rapid, quick change, development of new technologies, and regulations aren't going to keep up.
Right.
And we're going to see some bad actions, maybe not deliberate, right? That you're going to go, wow, in 5 years, this market's totally different. Like open banking could change the way banking takes place. And with that, there's risks involved in the system. So that's what I think about 3, 4, 5 years down the road. What are those risks that we all face that we need to be thinking about today?
Awesome. Well,
And if you're lenders, start learning collections practices now, because you will need them.
well, Deanna, Gary, thank you so much. This was, as promised, a lively conversation. Very much appreciate it. And thank you all for tuning in.
Thank you.
Thank you.